Welcome back to Click Capital, everybody, and the NASDAQ was the winner again today, the only US stock market index finishing in the green and making new highs for the year. And that was helped a lot by Google, which finished up 4.3% and made new highs for the year as well. And that was on the back of their annual developer conference yesterday, where they announced a bunch of AI products and are integrating their AI technology across most of their company. And that's something the market had really been looking for, as Microsoft with ChatGPT appeared to be way out in the lead. When Microsoft-backed ChatGPT was gaining a lot of popularity, the stock price of Google was struggling, especially after they released their chatbot back here. The market really didn't like it and sold it off hard. And there was a lot of doubts, including myself, whether Google could really step up and contend with Microsoft. And it looks like they've really reassured the market yesterday that they have, because we're breaking out here on pretty good volume. However, once again, it's a story of the mega cap tech leading the indices higher, because here's a chart of the NASDAQ equal weighted, and that actually made an inside day today, finishing down a little bit. Same with the SP500 equal weighted, that actually made lower highs, lower lows today and finished down as well. And apart from a few mega cap techs and some consumer defensive stocks, it was overall a red day out there, especially in the commodity complex. Energy, utilities, and a few industrials as well came off. Got the weekly jobless claims coming today, and they came in a bit higher than expected at 264,000. New people claiming unemployment benefits, that was versus expected 245,000. So the jobs market looks like it could be weakening a little bit. And PPI, a measure of producer wholesale prices, came in much as expected. So inflation still kind of holding steady in a soft little downtrend. And producer prices were expected to come back down as supply chains recover after all the COVID lockdowns. However, the market is still giving it a little bit of probability that we could get a hike in June. Today, 16% on Fed Fund futures, which was a little surprising today given that the banking mess is still ongoing. And regional banks actually got hit hard again today, down 2.5%, approaching new lows. And stay with me in this video, because I'm going to show you 10 regional banking stocks that I think could potentially be good long-term buys here. All of these 10 stocks are actually trading less than their tangible book value per share. And that's a measure of a company's assets minus its liabilities, and doesn't include intangible assets like goodwill, trademarks, and patents and things like that. So basically like a liquidation value. And these 10 stocks also meet my other measures of valuation, quality, and risk scores using our indicators as well. So stay with me, and in a little bit I'll take you through those 10 stocks. Fear and greed still in the greed zone, just came off a little bit at 59. Dark pool buys still hanging in there at 50%. Corporate insiders sold more stock yesterday, with 165 sales reported against 102 purchases. Options market still a little quiet, mostly calls as normal, and there we are again with the high yield puts being bought. And a potential growing tail risk for the market is the debt ceiling. If congressional leaders aren't able to fix it soon, and it's just going to be a question of which side bends first. And since we're almost halfway through May, there's only a couple of weeks left in this month, with estimates that the government could potentially default as soon as June 1 if Congress doesn't fix it. So that may put markets on edge over the upcoming weeks if this doesn't get fixed soon. And Bitcoin falls below 27,000 and has changed trend a bit, as it'd been trading inverse to regional banks ever since Silicon Valley Bank went under, but that's changed in the last few days. And that's because the US regulators are trying to get it out of the market. And earlier this week we saw Jane Street and Jump Crypto, two of the biggest crypto market makers, announce they'll take a step back from crypto trading in the US as the country regulators continue their crackdown. And so while Bitcoin will survive this, as everything will just move offshore, it's not a good thing when the biggest economy in the world rejects that. And we can see that in the price action of Bitcoin here, trading under its 50, breaking down to new lows here today. And Twitter co-founder, former CEO Jack Dorsey, who did appear to be a friend and in support of Elon Musk overtaking Twitter, has spoken out against him in recent days and has actually got a rival now called Blue Sky, which is a decentralized communications app similar to Twitter that he's in the process of growing. So it looks like Elon's now got some new competition. But I don't expect that to be overtaking Twitter anytime soon. I think Jack might be worried that Elon might just do a better job at making Twitter profitable and sustainable in the long term. And speaking of that, Elon Musk says he just found a new CEO for Twitter. He announced that the new CEO for Twitter will be starting in 6 weeks. And he will transition to being executive chair, CTO, overseeing product software and system ops. And that was a worry for Tesla investors, as they were worried that Elon Musk was too focused on Twitter, splitting his focus too much. So that may have helped Tesla stock finish up 2% here today. And activist investor Elliott Management has taken a position in Goodyear Tire and Rubber. They're pushing for a sale of Goodyear's 1,000+ retail stores. And they said with their recommendations, Goodyear stock could be worth $32 a share. And I had this one on my long watch list but may have missed it, as our stock fair value indicator has it fair value at $35 a share, a bit above what Elliott thinks it's worth as well. And just looking at a monthly chart here, it has been depressed for some time and it is a really strong global brand, so I think there is some value to be had there. And I still may look to enter this stock long on a pullback if we get one. And Disney stock got hammered today after reporting earnings yesterday, and the big reason is this number here. Analysts were expecting 163 million Disney Plus subscribers. They actually lost subscribers, came in 6 million less at 157 million. And so the street really didn't like that, marked the stock down almost 9% today, finishing near the lows on volume. And more troubles for COVID favourite Peloton, as they just record more than 2 million bikes. In a joint statement with the US Consumer Product Safety Commission, they record bikes from Jan 18 to May 21, as the seat post can break unexpectedly during use, creating a potential fall and injury risk. And once again, the market didn't like that, marking the stock down 9%. And just looking at a 2-week chart here, it's almost breaking down to all-time lows. And because this company keeps on losing money, our indicators don't like it. We've still got fair value at 380 on it. And it's basically always been overvalued. Back up when it got up to 171, our fair value on it was 66.95. And our stock crash risk indicator was almost at its highest level too, near 10 at a 9.78 reading, letting you know that the stock was really risky. And the saga continues between short seller Hindenburg and Carl Icahn, as they released another report today, plus announced they were shorting Icahn's bonds. And they came out today saying the famed corporate rater failed to disclose enough in response to questions raised in its critical report. And anybody can sign up for Hindenburg reports. Just Google Hindenburg Research, go to their website and enter your email in the box here, and you'll get all their reports they issue. And this is the one they issued today, saying Icahn's latest disclosures raised critical new questions about margin loans, continued portfolio losses. And just a quick summary of today's report they released. They said the most pressing question is raised in our report concerned Carl Icahn's pledging of over 181 million IEP units for margin loans, and despite promising to respond at length, he didn't offer any new details. And he said the annual reports indicate that Icahn added 3.4 billion in cash to his investment funds since 2014, but where did that money come from? They strongly suspect Carl Icahn pledged IEP units for billions in margin loans and reinvested those proceeds into his investment funds, which generated losses of roughly 53% from 2014 to 2022. And so they go on to say that their public investments have fallen further. They're carrying some losses they haven't reported. They're not providing any color on their private investments. And a big issue is their dividends are not supported by free cash flow. And they're saying that the dividends are just a return of capital. And so to sum up, Hindenburg Research is saying that Icahn is essentially saying to retail investors, buy $9 worth of value for $32 and I'll give you back $2 of your own money per quarter for free. Previously, retail investors have bought in, likely owing to Icahn's status and reputation. Given the current unit price, some seem to be realizing that Icahn, the famed corporate rater, may not be paying 15% cash per year out of the kindness of his heart. And just looking at Icahn Enterprises stock, it did fall 1.77% today, but did appear to find a few buys, but not on big volume. And yesterday with news that feds are investigating, this thing is going to go on for a while yet. And it'll be interesting to see if Hindenburg Research can bring down this long-term stock market player. But he is going to do everything he can to fight back. He just authorized a big buyback of his own shares, equaling almost 27% of the shares trading on the open market. However, that's just a bit of financial engineering, could be a bit of a short-term band-aid fix that doesn't fix the big underlying fundamental issues that Hindenburg is accusing them of. And the next most vulnerable California regional bank, PacWest, stock got slammed hard today after they said they just lost almost 10% of their deposits last week. And with that, I think it's creating some good long-term opportunities in the regional banking sector. And I'll show you now a list of 10 regional banking stocks that are currently trading less than their tangible book value per share. And basically, that's a measure of a company's assets minus its liabilities, and doesn't include intangible stuff like goodwill or trademarks or patents or anything else the company puts on their balance sheet that can't be liquidated. So you can kind of think of it as a liquidation score. So for example, if a company has net 100 million in assets after liabilities and the stock market capitalization is 90 million, then that stock is currently being offered at less than liquidation value. And so I'll just quickly run through 10 regional bank stocks where that's currently the case. And just as a reminder, this is not financial advice. I'm just sharing my research and opinion with you. And in addition addition to all these 10 stocks trading at less than tangible book value per share, which is this bottom indicator we have down here in the grey, I've also got our stock fair value indicators, which is a first on TradingView and uses a bunch of things to give an estimate of what a fair value should be for the stock. And it uses things like the company's balance sheet, its earnings, its past business growth rates, expected future growth rates, and takes things like Wall Street analyst expected future earnings and bakes that all into one price to give you an idea of what a fair value for a stock should be. And this is our own unique model. It's not like a standard discounted cash flow model. Also on the chart here, we've got our business quality score indicator, and that looks at a bunch of things like a company's profitability, return on equity, and a bunch of other efficiency ratios used to determine how quality the business is and dealing with capital. We've also got our stock crash risk indicator on the chart, and with the business quality score indicator, we're looking for positive values. Average is between 1 and 10, and good is above 10. And for this list of 10 regional banks, I've only included stocks that have a business quality score above 5. Next, we've got our stock crash risk indicator, and that value is always between 0 and 10, with 10 being really risky and 0 being low risk. So for this list, I've only included stocks with a stock crash risk less than 3. And on our stock fair value, I've only included stocks that are more than 50% undervalued. So to sum up, I've got 10 regional bank stocks where the current stock price is less than the tangible book value, it's more than 50% undervalued, business quality score is above 5, and stock crash risk is below 3. And anybody can get access to these indicators. All you need is a free account on tradingview.com. Then just head to our website, click capital.io, go to the indicators page and scroll down, and you can buy our indicators individually or get them all and save $200. All you need to do is enter your email address, your TradingView username, and check out safely with PayPal or Stripe with your credit card, and you'll get lifetime access to these indicators same day. Okay, so let's get into it. The first one is Ali Financial. We're just looking at a monthly chart here, and we can see that one is undervalued by 75%, business quality score at 7, crash risk at 2, tangible book value per share at $33.70, current price at $25.29. The next is Synovus, just a little bit under tangible book value, 72% undervalued, and good quality score at 14. Then we've got Wintrust at 64 tangible, currently trading at 60 a share, 68% undervalued. Bank of the Ozarks, 32 a share, a little bit above where we currently are now, 66% undervalued. Pinnacle Financial Partners, tangible book value sitting a little bit above the current stock price and undervalued by 76%. Cathay General, similar story. As with Ameris Bancorp, trading a little bit below tangible book value. Pacific Premier Bancorp, really high business quality score at 19.8. Independent Bank Group, been hit really hard over the last 4 months and currently trading 2 points below tangible book value. And last but not least, Veritex Holdings, currently trading just below $15 a share, tangible book value at $19 a share, and we've got fair value way above at $93 a share. So there's 10 regional banks that are undervalued and have healthy business quality scores, low crash risk, and are trading less than their book values. Now, just because they're cheap doesn't mean they're going to go right back up tomorrow or the next month. Being a value investor is actually quite hard. You've got to wait months and months, if not years, before the stock comes back to fair value, and there's going to be a lot of short-term volatility and risk on the way, as some of these stocks could still go a lot lower. Cheap can get cheaper. However, in my opinion, my bet would be as a whole, these 10 stocks will be significantly higher in 1, 2, 3 years from now. And a lot of them pay healthy dividend yields along the way. And even though there's still a lot of problems in the regional banking sector, most of these banks should survive because banking's not going anywhere. It's been around for hundreds of years and will continue to be around for hundreds more years. And I think the government with the FDIC will come out with the new insurance scheme that makes a bit more sense from the current $250,000 one. In my opinion, they should just charge everyone or balances above $250,000 just a few basis points per year in insurance fees, and that can cover, anything up to $10 million or something like that. And then maybe have business risk insurance payments as well to kind of ensure the whole system so there's no more runs on this with everyone worrying about their balances above $250,000. And so it should all eventually settle down once they sort it all out. And in hindsight, I think some of the prices that we're seeing on these regional bank stocks trading less than liquidation value should prove to be good buying opportunities when we look back at it. Okay, let's jump on back over to the charts and go through our market review before we go to our final outlook on the main indices. So international stock indices still trading sideways and weak, with most of them still pulling back. Implied volatility still really low, with the VIX just under 17. Put call ratio really low at 0.81. Most stocks still struggling, with only 36% of them above their 20-day average. Growth versus defensive sectors just holding above their 50-day. Most stocks continue to break down versus the market, as seen here in the Eco Weight versus the SPY. Growth versus value stocks made new year-to-date highs today, as did the NASDAQ versus the Russell small caps. Risk sentiment measure copper versus gold continues to break down. Commodities are still having a hard time versus stocks. The 2-year got down to 380 today, but was dip bought and just holding around 390. Same with the 10-year, holding in this big support zone just under 340 here. And here's the June Fed Fund futures contract at 507, that 0.07 just giving a little bit of probability that we get another hike next month. But the December contract's still at 440, with the market saying the Fed is going to have to do a couple of cuts before Christmas. Continue to see a nice bounce up from the support zone on TLT. With those lower rates today, we got most bonds moving up except high yield, which actually closed below its 50. Dollar looks to be finding support here at 101 and adding further pressure to commodities. The euro looks to have turned and lost its 50 as well, while the dollar versus the yen holds above its 50. Ethereum breaking down just like Bitcoin. Commodity complex coming down to test year-to-date lows again. Gold is the exception, still holding above 2,000 and looks to be coming up to test its 50. Silver came off hard today, down almost 5% on volume below its 50. Crude pulled back a little bit, but still holding above 70 a barrel. And adding downside pressure to the commodity complex as a whole was copper, down almost 4% as well on the news that inflation data out of China is weak, as they're having a bit of problems in their industrial and real estate sectors. And since they're the biggest user of commodities in the world, the commodity market does look to Chinese economic numbers. And over to stock sectors, mostly red out there, except for the IPO ETF, with IPOs picking up year over year, and ARK as well holding in there. Semis found lower lows, lower highs today. A bit of selling in gold miners today, closing below their 50 on volume. And defensive sectors, healthcare continue to hang in there just above their 50. And staples and utilities just above its 50. BlackRock trying to find support at yearly lows. NVDA still stalling out in the high 280s. Same with Apple and Microsoft. Amazon coming up to test year-to-date highs made back in early Feb. And after Disney saw that loss in Disney Plus subscribers, it looks like a few investors have piled into Netflix, closed up almost 3% today on a bit of volume. Robinhood reported earnings today, only losing 57 cents per share versus estimate 61 cents. As a reminder, the company's never made money. Just looking at a monthly chart here, we can see they got up to $85 a share. I remember on that day where it spiked just after the IPO, the company came out with a secondary offering and sold more stock to investors, basically slammed them down. And just a quick look at our fundamental indicators on the stock. We've still got fair value a bit lower at 850. Negative business quality score at minus 33. Stock crash risk is low as the stock's already crashed. And tangible book value at 760 a share. Similar story with Beyond Meat. They just reported and they lost 92 cents a share versus estimate 101. Stock got hammered 18% today. We've got fair value at 415. And even though the company has some good quality metrics and low crash now that we've already crashed, there's still a negative tangible book value per share. And that's because the company has more liabilities versus assets, 1.27 billion versus 1.06 billion. So if the company were to get liquidated, it would actually owe more money than what they have in liquidable assets. And here's a look at Pac West, which is down 22% today to 470, not as low as last week. And looks like people are trying to dip by this, as this looks to be skating on thin ice, holding on a thread to survive. But they really need to stop the run on deposits or get a buyer or a partner deal with something. Otherwise, this could be the fourth California bank to go under in recent times. Arizona-based Western Alliance is hanging in there as well. Same with Zions and First Horizon as well. They've all suffered big deposit outflows and getting their net interest income squeezed. Schwab just went ex-dividend today, paying out 25 cents per share to investors and is hanging in there. But doesn't look to be making strong signs of a bottom. We really need some good news out of this thing to get it back above its 50, which it's never closed above since all this mess with silicon started back in mid-March. Okay, back over to the SP 500, currently at 4130 here on an inside day. Volatility still coiling up. Central banks continue to taper their asset purchases, reducing liquidity in the system a little bit. And we're now a bit over a 250-point bearish gap between the two. And most stocks continue to trade really weak, as we can see in the SP 500. SP500 equal weight index, and the NASDAQ equal weight as well, going sideways at best and really low volatility. Dow actually closed below its 50 today for the first time in over a month. Mid caps still in a short-term downtrend, same with small caps and micro caps as well. And with all of that, I continue to keep a bearish tilt in my portfolio, increasing net short 60% today. And we'll see what happens tomorrow on the last trading day of the week. That's all I've got for you today. Thanks very much for watching again. If you found value in this video, I'd appreciate it if you hit the like and subscribe button. And I hope to see you again tomorrow afternoon. Cheers.